and welcome to this edition of BizWatch. I'm Qingyi. China's share market started April strongly, with Shanghai's key index hitting its highest level in more than 18 months. Metal, power, and the construction sectors enjoy the biggest gains. Li Chuanmiao finds out the reasons behind the rebound and the current status of the market in the wake of last year's reform.
It was an exciting week for mainland stock investors. The benchmark Shanghai Composite Index, which tracks both A and B shares, extended its upward trend, passing 1,340 points to its highest close since November 30th, 2004.
Prices of non-ferrous metals on the international futures market have stayed high recently, which brought up the share price of domestic non-ferrous metal-related stocks. Speculation on further RMB revaluation and the booming Chinese economy also attracted more capital inflow to the market. Some international fund managers are very optimistic about China at the moment.
Trading volume on the two markets also approached the record highs. For the fourth time in a year, the A-share market daily trading volume exceeded 20 billion yuan. Experts attribute this to last year's stock market reform, saying the growth in volume was a very positive sign.
The split share reform last year helped compensate private investors by reducing their investment costs. Thus, the market is now much more suitable for investment.
Experts say the current surge are partly a natural reaction to heavy falls last year, and the stock market reform isn't the only influence.
The market scale has shrunk because several hundred companies are still suspended from trading as part of the stock reforms. The market is positively responding to that. Also, lots of the companies are releasing their annual reports, and that stimulated the market.
Overall, the markets are still at the crossroads. We first have to set up a reasonable pricing system and make the market more open so that it can decide its own direction. It also needs stronger government supervision to prevent fraudulent activity.
A recent report by US-based Emerging Portfolio Fund Research shows emerging securities markets attracted $20.3 billion globally in 2005, 5 times that of 2004. Analysts say the launch of the government policies such as QFII and QD are expected to make the mainland and Hong Kong markets more attractive to investors, but say there are still a lot of preparations to do.
There is still a structural problem in our markets. It is one-directional. We don't have downside hedging mechanisms involving derivatives such as options, futures. In such case, a downturn will hurt every investor.
Professor Hu says the government is considering introducing such derivatives, but this year's target is to implement legislation for the securities market to create more transparency and foster sustained growth. Li Chuanmiao for BizWatch.